Welcome to the DX Today podcast. No hype, just facts about artificial intelligence and digital transformation. And today we are diving deep into the question that is just hanging over every major portfolio, every investment committee, and frankly, every corporate boardroom across the globe.
It really is.
Are we living through a dot-com bubble 2.0, or is this current AI supercycle fundamentally structurally different? Our listeners shared some incredibly rigorous sources that painstakingly compared the late 1990s speculative mania with the frenetic 2023-2025 AI investment boom.
And what they reveal is it's that the answer is far more nuanced. And I'd say, frankly, more alarming in certain areas than just a simple historical echo.
It is, and understanding that nuance is, it's absolutely everything for decision-making right now.
It is. Our mission for this deep dive is to surgically move past those surface-level similarities, the things that make every investor nervous.
You mean the parabolic stock charts, the eye-watering venture capital rounds?
Exactly.
Yeah.
Charismatic CEOs, all of that. We need to get to the central question. Is this just a speculative mania fueled by pure fear of missing out? Or are we truly witnessing a fundamental structural reordering of the global economy?
Because if it's the latter, the risks we're facing are they're entirely different.
Completely different.
And the sources, they really don't waste any time. They jump right in with this powerful initial thesis. They argue that the AI boom is what they call a mania of the robust.
It's a great phrase.
A mania of the robust. Just that phrase alone tells you so much, doesn't it? It signals immediately that we aren't looking at the same structural risks we saw, 25 years ago?
Right. Not when the market was built on, vaporware and borrowed money.
Like House of Cards.
Exactly.
Yeah.
The core conclusion the sources draw is that, unlike the late 90s, this AI boom is led by technological incumbents, the Microsofts, the Googles, the Amazons. These are companies with fortress balance sheets. They're generating hundreds of billions in free cash flow. So this inherent financial strength, it just fundamentally changes the risk profile.
So a total systemic collapse of the financial system, that's less likely. The kind of cascading bankruptcy risk that we saw in the early 2000s.
It's far less likely. The problem isn't insolvency. These companies aren't going out of business.
But, okay, if the system isn't going bankrupt, that doesn't mean our listener or, their investments are safe. If this mania of the robust crashes, what happens then?
It doesn't mean it's risk-free. Quite the opposite. The sources strongly suggest that a severe sectoral correction is highly probable, maybe even inevitable.
And that correction, it won't be triggered by bankruptcy, but by something they're calling the return on investment gap, the ROI gap.
That's it. In the simplest terms, the speed and the sheer scale of the infrastructure build out all the chips, the data centers, it's just vastly outpacing the speed at which we can generate actual, measurable, profitable revenue from the AI applications running on top of it.
So the technology is real.
The technology is absolutely real, but the price we're paying for it today might not be.
So what does this all mean for you, the listener? If you're deciding where to deploy capital, whether that's your personal investment strategy or your company's next 5-year strategic roadmap,
then understanding if your strategy is built on the bedrock of free cash flow or on, speculative sand is the difference between surviving a potential crash and seeing your plans just completely wiped out.
Let's unpack this structural divergence then, starting with the financial architecture. Okay, let's start with the fundamental difference in the fuel that's powering these two booms, the money itself. We have to talk about the quality of earnings and the general financial health of the market leaders in both eras. In the late 90s, the market was absolutely high on eyeballs, on potential, on this idea of, unlimited growth.
The contrast here is it's utterly staggering. It's really the difference between a mature oak tree and, say, a sapling that's been planted in sand.
That's a good way to put it.
If you look back at the dot-com era, specifically March 2000, the NASDAQ was trading at an astronomical price-to-earnings ratio, a PE of over 200.
200? It's hard to even comprehend that.
It is. But the core problem wasn't just how expensive the stocks were. It was whether the companies would even exist in a year.
Right. So tell us what the research at the time, what did Barron's find about the balance sheets of those companies?
The research painted this terrifying picture of fragility. Barron's reported that 74% of 207 publicly traded internet companies had negative operating cash flows.
74%. 3 out of every 4 dot-coms were losing money just running their core business.
Just opening the doors in the morning. And it gets worse. 51 of those companies, that's a quarter of the total, they were projected to run out of cash entirely within 12 months.
Wow. So the entire ecosystem was built on a time bomb. They needed constant, fresh injections of equity or debt just to keep the lights on and pay salaries.
Precisely. You just have to think about the famous examples Pets.com, Webvan, Boo.com. They went public with practically zero sustainable revenue, huge burn rates.
And they relied entirely on what? Continuous speculative equity offerings, junk debt.
All of the above.
Ah.
And when the capital markets finally slammed shut, the collapse wasn't just a stock price correction, it was insolvency. They ran out of money, they couldn't meet payroll, and they simply ceased to exist. Their assets were sold for pennies on the dollar.
Okay, now let's contrast that extreme fragility with today's AI leaders. The so-called Magnificent Seven, Microsoft, Apple, NVIDIA, and the rest. These companies aren't just sitting on cash. They're generating it at an unprecedented scale.
They are. I mean, they are fundamentally different economic entities. They are fully mature, quasi-monopolistic corporations that are generating hundreds of billions in free cash flow annually.
Right.
For example, in 2024, Microsoft alone generated over $80 billion in free cash flow. So they're funding this massive AI CapEx supercycle, the chips, the data centers, the R&D internally.
From the profits on their existing established monopolies.
Exactly. Windows, Office 365, Amazon Web Services, the legacy Azure cloud business. It's a completely different fuel source.
And that is the structural shift.
Yeah.
The source of funding has completely flipped from external speculative cash to internal, established, highly reliable revenue streams.
And that's why the risk profile shifts so dramatically. The risk is no longer bankruptcy risk. It is purely valuation risk. This is the crucial distinction our listener needs to grasp.
Explain that. So if Microsoft's stock price falls 50% tomorrow.
Which would be a catastrophic event for shareholders, no doubt.
Of course.
But its AI operations are not jeopardized. The company simply reallocates existing cash flow. The profits from Office 365 or Azure's established business keep funding the billion-dollar CapEx needed for the next generation of models.
The technology keeps getting developed. The company keeps operating.
It keeps going, so lights stay on. That structural security is the big difference.
Okay, that's reassuring on a systemic level, but let's press on that valuation risk because even if the core businesses are robust, investors are clearly pricing these stocks for a growth trajectory that historically just might be impossible to maintain.
And that's where the mania still lives. While the overall S&P 500's PE isn't at those 2000 peaks, some of the AI-specific valuations are, well, they're stretched to the breaking point.
Look at NVIDIA.
NVIDIA is the perfect example. Its forward PE has been fluctuating wildly, somewhere between 30 and 60, depending on the week.
Now, that's lower than Cisco's peak in 2000, right? That was something like 150 times earnings?
It was, 150. A valuation that basically priced the company as if it would literally own the entire future of the internet. But a PE of 60 for NVIDIA still embeds this expectation of continued, almost infinite exponential growth.
And remind us what happened to Cisco. I mean, it was a perfectly healthy, incredibly profitable company. It didn't go bankrupt.
Cisco was the gold standard of its day. Profitable, dominant, financially sound. But when the market realized that the 100% year-over-year growth that was priced into that 150 PE ratio was it was physically unsustainable.
That eventually every business that needed a router would, have one.
Exactly. The market saturates. And the multiple compressed. Violently. Cisco stock lost 80% of its value even though the company itself never went bankrupt and continued to generate strong profits.
So any signal today that NVIDIA's, 400% year-over-year growth rate might slow to, say, 50% or even a really healthy 20%.
It's going to trigger that same violent compression. The valuation gets reset to reality.
And we can't discuss valuation without discussing market concentration, which the sources argue is even more extreme today than it was during the dot-com era. And this is a vulnerability that affects everyone, even conservative index investors.
The concentration conundrum is a massive vulnerability in the current market architecture. In 2000, the rally was dominated by the four horsemen, Cisco, Intel, Microsoft, and Oracle. Their collective weight was substantial.
But today, the Magnificent Seven, Meta, Apple, Amazon, Alphabet, Microsoft, NVIDIA, Tesla, their footprint is historic.
The concentration is unparalleled. These seven companies account for about 35% of the total S&P 500 market capitalization.
A third of the entire market.
And the data from 2025 is even more shocking. Roughly 75% of the S&P 500's year-to-date gains were attributable to just these seven companies. And really, primarily NVIDIA and Broadcom, the core suppliers of the AI infrastructure.
So if I'm a passive investor and I'm just using a standard diversified index fund for my retirement, I'm unknowingly making a huge leveraged bet on the AI thesis, whether I wanted to or not.
That's the critical risk implication. You have created a single point of financial failure for a massive swath of global capital. If the AI thesis stalls, or if one of these key players runs into a major technological, regulatory, or geopolitical issue.
Like a manufacturing delay at TSMC due to regional conflict or a massive antitrust action from regulators.
The impact is felt not just in the tech sector, but across the entire market where passive index investing now dominates. The concentration risk is magnified not only financially but also across the physical supply chain, creating these compounding fragilities.
That concentration leads us directly into what I found to be the most fascinating and, frankly, deeply unsettling concept in the source material, the Ouroboros economy, or circular financing. This practice sounds suspiciously like the internal balance sheet tricks we saw used in the Enron and WorldCom era, even if it is technically legal today.
It raises immediate red flags, and for that exact reason. It fundamentally distorts true market signals and the perception of organic growth.
Ouroboros, the ancient symbol of a snake eating its own tail.
It's the perfect analogy for this self-sustaining circular flow of capital.
Okay, so let's clearly define the mechanism for the listener. How does this circular financing work today between the giant tech companies and the AI startups?
The process is it's elegant in its simplicity and insidious in its effect. It starts when a massive tech giant or hardware manufacturer, let's say Microsoft or NVIDIA, invests venture capital, usually billions of dollars, into a high-profile AI startup like OpenAI or Anthropic.
Okay.
But there are specific strings attached to this investment. The contract often requires the startup to immediately cycle that capital right back to the investor by purchasing their cloud services or their hardware.
So the money flows out of the giant's balance sheet as an investment, and then it flows right back in as what they get to label robust services revenue. They're essentially manufacturing their own growth.
That is the core distortion. The tech giant records the money leaving as a non-operating expense, an investment on the balance sheet, but it records the money coming back in as operating revenue, a real JAP-compliant sale of cloud credits or hardware.
Which makes the market look much bigger and the tech giant's growth rate look much healthier.
Than if the startup had secured that funding organically from actual external customers.
Give us the specific examples that the sources cited.
Well, Microsoft's relationship with OpenAI is the most famous, the poster child for this.
Right.
Microsoft invests $13 billion into OpenAI.
Right.
OpenAI then immediately uses that investment cash to pay for the massive amount of Azure cloud credits that it requires to train its GPT models.
And Microsoft then gets to book that transaction as significant recurring cloud revenue growth, often citing AI demand as the driver in their earnings calls.
They do. And on the hardware side, NVIDIA does the exact same thing with the dedicated GPU renters, the so-called neoclouds.
Right, these companies that just rent out compute time.
Exactly. NVIDIA invests hundreds of millions, sometimes billions, in emerging cloud providers like CoreWeave or Lambda. CoreWeave then uses that fresh cash injection, often along with debt collateralized by the chips themselves, which we'll get to buy vast quantities of H100 GPUs directly from NVIDIA.
And NVIDIA books that as massive, explosive data center revenue.
It's a perfect closed financial loop.
It creates a beautiful mirage, doesn't it? The revenue looks organic and market-driven, giving the illusion of explosive adoption, but it's really an internal balance sheet reclassification being passed off as real market growth.
And this isn't a new trick. The sources point out that this is eerily similar to the vendor financing issues of the late dot-com bubble.
How so?
Well, telecom equipment makers like Lucent or Nortel would lend huge sums of money to fledgling telecom carriers, WorldCom being a major client, specifically so that those carriers could afford to buy their expensive network gear.
So when the startups failed,
The equipment makers were hit twice. They lost the capital they lent, and they had to reverse all the revenue they'd prematurely recognized. It was a disaster.
but today there is at least some regulatory scrutiny, which is a positive sign compared to the 90s, where things often ran wild before regulators stepped in.
That's a key distinction. The Federal Trade Commission, the FTC, has launched inquiries into the financial architecture of these major AI partnerships.
Specifically, Microsoft and OpenAI and Amazon and Anthropic.
Right. They aren't necessarily focused on the legality of the accounting itself, but rather if these deals create market distortion, financial opacity, and dangerous lock-in effects that stifle genuine competition, they're asking, is the market seeing true demand, Or is this demand being artificially manufactured by the investors themselves?
So what's the ultimate danger here? If this circularity is as widespread as it seems, what happens when the initial investment cash runs out and the Ouroboros can no longer feed itself?
The danger is the dramatic exposure of that ROI gap we mentioned earlier. The tech giants' current revenue streams are contingent on these AI startups successfully generating organic revenue from millions of paying end users, actual businesses and consumers, beyond the initial capital injections.
So once the VC money is gone,
If the investment capital runs dry, and the startups can't sustain the huge recurrent payments for chips and cloud compute, if they fail to find those paying enterprise customers, then the revenue streams that Microsoft, Amazon, and NVIDIA are booking could just evaporate overnight.
it would reveal that the explosive growth they cited in their quarterly earnings calls was less about market demand and more about the internal redistribution of capital within a highly concentrated ecosystem.
It just artificially extends the mania, ensuring a much sharper, much more painful reckoning when the underlying application layer doesn't deliver on its promises.
Moving on to the physical assets being created, this is maybe the single most important structural difference that makes the AI supercycle inherently riskier than the dot-com bubble. The lifespan of the assets being built. We're talking fiber versus silicon.
And this defines the severe economic pressure being felt across the entire sector. In the dot-com era, the massive infrastructure build-out focused on the physical layer, laying fiber-optic cable across continents, installing routers and switches.
And the key characteristic of that fiber was its fundamental utility and its durability. It lasted.
Exactly. Fiber optic cable is incredibly physically durable. It has a useful economic and physical lifespan that easily exceeds 20 years. So when WorldCom and the others went bankrupt, they left behind vast amounts of what was called dark fiber.
It was worthless on their books at the time.
It required a massive write-down, but it didn't physically degrade. It was eventually wiped clean in bankruptcy proceedings, sold for cheap, and it became the ultra-low-cost backbone that allowed Web 2.0 to flourish.
So the failed assets of the first bubble actually became the critical low-cost foundation for the next successful technological wave. It was an intergenerational subsidy in a way.
It was an incredible silver lining from a massive collapse.
Yeah.
Now, compare that legacy asset to the core AI asset today, the graphics processing unit, or GPU, and the specialized data centers that house them. Hyperscalers are expected to spend $400 billion in 2025 alone on this infrastructure.
$400 billion. But the lifespan of a cutting-edge H100 chip or a specialized data center is measured in single-digit years, not decades.
And that's what the source material accurately terms the depreciation cliff. A high-end chip, like the H100, has a useful economic life of only 3 to 5 years before it's superseded by a vastly more efficient architecture, like Blackwell or Rubin.
And that new chip offers, what, 4 to 5 times the performance per watt?
At least. Which means today's $40,000 server is essentially tomorrow's electronic waste. There is no latent, long-lasting value like dark fiber.
That is the structural urgency, isn't it? A massive farm of 5-year-old GPUs sitting idle in 2028 will be functionally worthless. They'll just be taking up space and consuming vast amounts of power relative to their output.
Which puts the companies building this infrastructure under immense use-it-or-lose-it economic pressure. They cannot afford to wait 5 years for demand to catch up. They have to monetize that infrastructure immediately to cover the staggering depreciation costs.
Let's quantify that financial pressure. The scale of the write-downs that could be required is truly staggering if that ROI gap isn't closed quickly.
It is. If you project that $400 billion in annual capex for 2025 across a generous 5-year depreciation schedule, that results in an estimated $80 billion in annual depreciation charges alone, minimum.
$80 billion a year.
And the source material emphasizes that this massive recurring depreciation figure currently dwarfs the actual organic revenue being generated by generative AI applications today. This gap creates a financial sword of Damocles hanging over the tech giants.
So if rapid-scaled adoption doesn't fill that gap,
A violent correction is inevitable, as they are forced to write down the value of all that obsolete hardware.
now let's introduce the secondary risk factor here, the debt that is financing this rapidly depreciating asset. This is where the structural comparison to the subprime mortgage crisis becomes frighteningly clear, especially when you focus on the neocloud segment.
This is the most precarious area of the entire ecosystem. The neoclouds, companies like CoreWeave, which specialize in renting GPU compute, have raised billions and billions in debt financing.
And here's the core risk. The collateral for those loans is the GPUs themselves, the H100 chips, which are currently valued based on scarcity.
That's right. And the lenders are the biggest players in the private credit market. BlackRock, JP Morgan, Carlyle, major sovereign wealth funds. These funds have been desperate for yield and have provided complex, bespoke financing using the chips as asset-backed collateral.
So why is this like subprime? Subprime involved inflated home prices backed by junk mortgages. How does that translate to a piece of silicon?
It perfectly mimics the dynamic of collateral valuation risk. In the subprime crisis, lenders valued the collateral, the homes, based on artificially inflated, scarcity-driven prices fueled by cheap credit.
Right.
Here, lenders are valuing the GPUs based on current scarcity-driven prices.
Right.
An H100 cost maybe $35,000 to manufacture, but it was selling for $40,000 or $50,000 due to scarcity and demand. The loan-to-value ratio is based on that inflated spot price.
And if NVIDIA increases supply, or if a new architecture like Blackwell is released, the intrinsic value of those older H100s, the collateral, it just plummets.
Exactly. Blackwell acts as the equivalent of the 2008 interest rate reset, or the collapse in housing prices. The collateral suddenly loses 50 or 75% of its perceived value overnight.
Which immediately renders the neocloud loans under-collateralized.
And that could trigger technical defaults, especially for the firms that are highly leveraged.
And a default in this sector would hurt those massive private credit funds, and it would flood the secondary market with cheap chips, accelerating the depreciation cliff for everyone else.
It creates a localized but potentially severe credit freeze. Billions in defaulted debt would mean the private credit funds would need to liquidate the collateral, those H100 chips. This floods the secondary market, crushing the margins for NVIDIA and accelerating the obsolescence schedule for every company that just bought new hardware. It's a highly leveraged segment sitting on a rapidly depreciating, technologically obsolete asset.
All of this financial and infrastructural pressure brings us right back to the core challenge, the ROI gap. Sequoia Capital framed this perfectly with what they called the $600 billion question. Given the hundreds of billions in capex we just discussed, where is the commensurate revenue to justify it?
That question cuts right to the heart of the matter. Based on current expenditures and the necessary depreciation coverage, the ecosystem needs roughly $600 billion in annual, sustained, high-margin revenue just to break even on the current infrastructure build-out.
$600 billion.
And the overwhelming concern is that outside of a few known visible success stories, ChatGPT subscription revenue, GitHub Copilot licensing, internal ad optimizations at Meta and Google, there are vanishingly few killer apps generating that kind of standalone scaled revenue.
It feels like we're still largely stuck in the feature phase, where AI improves an existing product rather than the platform phase, where AI is the product.
That's the friction. Most AI revenue today is still feature revenue. It's integrated as an add-on or a marginal improvement, like Copilot being bundled into Microsoft Office. And the adoption rate, specifically within the enterprise, is proving to be uncertain and very slow.
This is what the sources call pilot purgatory.
Pilot purgatory. Enterprises are experimenting, they're running trials, but they are stalling on massive, full-scale deployment.
And the data on those stalled initiatives is striking. It suggests a really widespread enterprise frustration with the current state of implementation.
It really hammers the point home. S&P Global Market Intelligence reported that the share of businesses that scrapped most or all of their AI initiatives actually increased to 42% in 2025.
42%. That's a massive jump from just 17% the previous year.
It is, and the reasons are consistent across the board. The cost of compute is too high, there are severe data privacy concerns, and the difficulty of proving a tangible, measurable, and scalable ROI within their legacy systems is just too great.
So if a major financial services firm finds that implementing an expensive new LLM assistant increases staff productivity by, say, 10%, but the total cost of licensing, compute fees, and integration consultancy is 30% higher, the spending just starves.
Of course it does. It's the field of dreams risk. They built the data centers, but the paying customers aren't showing up in the numbers required to justify the massive investment.
It's the classic trough of disillusionment.
That's the crux of the friction. The market is currently experiencing the textbook trough of disillusionment phase of the hype cycle. The technology itself is impressive, it's revolutionary even, but the implementation is messy, expensive, and difficult to integrate into existing complex workflows. It often fails to clear that very high bar of investment justification.
But historical context always offers a powerful counter-narrative to short-term skepticism. We have to balance the ROI gap with Amar's law. We have to look at the long-term view of general-purpose technologies.
Amar's law is essential here. We tend to overestimate the effect of a technology in the short run and underestimate the effect in the long run.
And the collapse of the dot-com bubble is the clearest illustration.
It is. It felt devastating in 2001, but it didn't stop the internet. Instead, the resulting glut of cheap bandwidth, that failed fiber infrastructure we talked about, created the perfect low-cost conditions for entirely new business models like YouTube, Netflix, and Facebook to thrive years later.
So the immediate financial crash paves the way for the eventual sustained productivity boom by making the foundational resource affordable.
Precisely. And if the AI financial bubble bursts, if we see a massive valuation compression for NVIDIA, the neoclouds fail, it will lead to a dramatic deflation in the cost of intelligence.
So if the cost of renting GPU compute drops from dollars per hour to pennies per hour.
That would be brutal for the infrastructure investors, but it would be a monumental boon for the application developers who are currently stuck in pilot purgatory. It shifts the economic focus from expensive training of models to ubiquitous cheap inference.
And this slow diffusion, it tracks perfectly with the historical adoption of other general-purpose technologies, or GPTs.
Absolutely. AI is a general-purpose technology, just like electricity. The railroad, or the internal combustion engine, were revolutionary. These technologies require time decades, often to show up in macroeconomic productivity statistics.
Why is that?
Because they demand that entire factories, supply chains, and business processes be completely redesigned to utilize them effectively. You can't just drop an electric motor into a steam-powered factory and see results. You have to reinvent the factory floor.
And the Wharton School, they estimate that AI's major boost to productivity growth will actually peak in the early 2030s.
That's right. The benefits are real, but they are delayed, which explains the current ROI gap friction. It takes time for the organizational changes to catch up with the technological capabilities.
The dot-com bubble was ultimately constrained by the digital limits of bandwidth. Our sources point out that the AI supercycle is constrained by something far more fundamental, elemental, and physical: physics, specifically energy. This is a hard limit that was simply absent in the 1990s boom.
It is the energy ceiling, and it imposes a physical brake on infinite growth. The power demands of generative AI are they're staggering, and they're scaling exponentially faster than our ability to build power plants.
A single LLM search query can use, what, 10 to 15 times the energy of a standard Google search?
At least. And globally, data centers are projected to consume unprecedented amounts of energy.
Give us the most sobering projection from the source material regarding that global energy consumption.
The forecasts are truly sobering. Some major utilities and energy market analysts suggest that AI infrastructure globally could consume as much electricity as an entire developed nation, like Japan or Germany, by 2026 or 2027.
An entire country's worth of energy dedicated almost exclusively to training and running models within just a few short years. That magnitude means you can't just spin up a new AI startup with a cheap server anymore.
Exactly. And this is why the physical constraints act as a natural brake on the mania that was not present in the 90s. In 2000, if you had capital, you could instantly rent a server and start a website.
But today, you can't just code a new power plant or transmission line into existence.
You can't. Building the necessary energy generation and transmission infrastructure takes 5 to 10 years due to permitting, construction, and planning.
And we are already seeing this friction halt growth in critical areas globally.
We are. In key data center hubs like Northern Virginia, Dublin, and parts of the Netherlands, utility companies have publicly struggled to keep pace. New data center connections have been paused or severely restricted due to concerns about grid instability.
So this fundamentally limits the infinite proliferation of startups and GPU farms that characterize the purely digital explosion of the dot-com era. If you can't get power, you can't train a model.
Simple as that.
But the sources also point out this fantastic paradox here. AI is both creating this immense energy demand and potentially being used to solve the very crisis it's exacerbating.
That's the technological counterforce at work. It's a race against itself. AI systems are actively being deployed to optimize the power grid itself, balancing intermittent loads from solar and wind, predicting demand spikes, and improving the efficiency of existing fossil fuel and nuclear power plants.
And even more dramatically, it's accelerating research into fusion energy.
It is. Programs like the Genesis mission are leveraging AI to model and control plasma instabilities in experimental reactors, potentially shaving years off the timeline for sustainable nuclear energy.
Moving from physics to geopolitics, the supply chain constraint is another massive risk factor that was largely absent in the globalized 1990s. We're talking about the chip war and the concentration of manufacturing risk.
Right. The AI supply chain is dominated not by market forces, but by geopolitics.
Yeah.
Specifically, the U.S.-China trade war and the resulting export controls on advanced chips,
And the entire ecosystem is tethered to one key supplier, NVIDIA, and one key manufacturer, TSMC, in Taiwan.
which creates an extreme concentration risk that the internet infrastructure build-out of the 90s just didn't face. They had competing chip architectures and geographically diverse manufacturing.
The U.S. government has restricted the export of advanced AI chips to China, which has fundamentally distorted the global market dynamics.
It has created chaos. On the demand side, it has fueled a black market for high-end chips, with smuggling rings moving chips through Southeast Asia to mainland China at huge markups.
And on the supply side,
It forces Chinese tech giants to hoard older chips and simultaneously invest billions in developing a parallel domestic semiconductor supply chain, often using older, less efficient processes.
and what does this ongoing trade war mean for NVIDIA's long-term revenue stability?
It creates a major long-term structural risk. Historically, the Chinese market accounted for 20 to 25% of NVIDIA's total revenue. That massive China revenue hole is currently being fully masked by the insatiable short-term demand from U.S. hyperscalers who are building out their infrastructure.
But if that U.S. demand inevitably cools,
The geopolitical limitations will hit NVIDIA's top line acutely, compounding the valuation risk we discussed earlier. Geopolitics is no longer an external factor. It is a primary structural market force.
we've focused heavily on the financial risks, the infrastructure challenges, the geopolitical limits. But what I find truly compelling is that the sources identify a significant floor under this AI revolution that is entirely independent of stock market hype.
Right.
Genuine, measurable scientific progress.
Right.
This is where the real value is being created, irrespective of quarterly earnings calls.
This is the strongest evidence distinguishing this boom from the pure vaporware of the late 90s. The application of AI to the hard sciences, biology, material science, chemistry, physics, is generating non-speculative, undeniable, and often astonishing breakthroughs.
Let's elaborate on what the sources call the AlphaFold moment.
The AlphaFold moment, driven by Google DeepMind's models, refers to the successful prediction of the structure of nearly all known proteins. This was a grand challenge in biology that had stumped researchers for half a century.
And why does this matter so much?
Because understanding protein structure is the absolute key to understanding disease pathology and designing precision therapeutics. It fundamentally alters the starting line of drug discovery.
And how does that translate into immediate, non-speculative economic and human utility?
It fundamentally alters the economics of drug discovery, ushering in what they call the tech-bio revolution.
Yeah.
Traditional drug development is a brutal process, 10 to 15 years, billions of dollars, and a crushing 90% failure rate.
Right.
Early AI-designed drugs are showing success rates in phase I trials between 80 and 90%, compared to the historical average of 40 to 65%.
That's a huge difference.
It's a game changer. Development timelines are potentially cut from years to months by AI-native companies like Isomorphic Labs and in silico medicine. The economic implication is that pharmaceutical companies are beginning to fundamentally shift their R&D budgets toward these AI-driven methods. This value is tangible. It's not a feature, it's a foundation.
So even if the financial bubble bursts, the underlying ability of AI to cure disease or design better materials, that remains immensely valuable. It provides a safety net of real utility.
It provides a massive floor of utility that the pets.com economy simply did not possess. And similarly, AI is accelerating material science discovery. We see this with efforts like Microsoft's Madrigen model and national initiatives like the Genesis mission.
And these programs leverage AI to do what, exactly?
To simulate millions of experiments, accelerating material discovery from decades to mere weeks.
And these are highly relevant to massive global challenges, right? The energy transition, for instance.
Crucially relevant, this atoms not bits focus is necessary for the energy transition. Designing safer, more energy-dense battery chemistries, creating highly efficient solar cells, and inventing lighter, stronger alloys crucial for next-generation EVs and carbon capture technology. Even if the commercial markets reset, the strategic, non-economic demand for AI compute to solve these fundamental physical constraints will persist.
And that leads us to the second critical floor, the geopolitical demand, or what the sources termed the sovereign put option. Governments are treating AI compute as critical national infrastructure, and that creates an undeniable economic cushion.
This is perhaps the single biggest financial differentiator from 2000, where governments were largely reactionary. Today, nation-states are active, powerful market participants. They view AI compute, especially the most advanced chips, as a strategic resource.
Akin to oil reserves or advanced defense capability.
Exactly. They aren't waiting for the ROI calculation. They're investing for strategic necessity. We're seeing multi-billion-dollar initiatives specifically designed to procure chips and build massive data centers, often independent of near-term commercial ROI.
Who is leading the charge?
Saudi Arabia, through its public investment fund, is investing tens of billions. The UAE via G42 and MGX, France, and the UK have all launched massive sovereign AI cloud projects. Saudi Arabia isn't investing solely for Q3 2026 commercial returns.
They're investing for a post-oil economy in 2035.
That's the strategic play. And this non-economic strategic demand ensures that the infrastructure build-out will continue longer than purely commercial market forces alone might dictate. It dampens the severity of a potential commercial crash.
The geopolitical FOMO provides a vital financial floor.
It does. Even if venture capital dries up for smaller startups, the demand for massive quantities of chips and data center capacity from governments, driven by the desire for national defense, economic diversification, and technological leadership, will remain robust. It's a stabilizing force in an otherwise volatile sector.
Okay, let's synthesize this massive amount of data. We have the financial strength of incumbents, we have the accounting trickery of circular financing, the urgency of the depreciation cliff, the severe ROI gap friction, hard physical limits from energy, and this stabilizing geopolitical floor. What does the final outcome look like when this market fever inevitably breaks?
Well, the evidence points overwhelmingly toward a severe sectoral adjustment rather than systemic economic devastation.
An adjustment, not a collapse.
Right. The financial foundations are sturdier because the companies leading the charge are generating real profits. But expectations have wildly outpaced the messy, expensive, bureaucratic reality of implementation. So we need to distinguish clearly between two likely scenarios that will probably play out at the same time.
Scenario A being the most likely fate for the market leaders and those high-flying stocks like NVIDIA, the so-called Cisco trajectory.
The Cisco fate is the highest probability outcome for the established giants. As we mentioned, Cisco survived the 2000 crash as a profitable company, but saw its stock collapse 80% because it was priced for perfection and unsustainable growth.
And NVIDIA is in a similar position as the picks and shovels supplier.
It is. It is a phenomenal, profitable, well-managed company.
But if its growth slows down to, say, 20%, which would be fantastic growth for any other sector, what happens to the stock?
Its multiple will compress violently. Investors who paid 50 or 60 times earnings for 400% growth will abandon the stock if that rate slows to 20 or 30%, no matter how profitable the underlying business remains.
So the valuation adjusts to a realistic long-term growth rate. Massive pain for investors.
But the company itself remains financially healthy, continues its R&D, and continues to dominate its sector. This is a painful valuation adjustment, not insolvency.
Okay. Now, what about the area of genuine devastation, scenario B? The true subprime parallel.
That destruction will be localized and highly concentrated in the neocloud sector and the private credit funds that back them. This is where the structural weakness is most exposed.
So if oversupply hits, if NVIDIA finally ramps up production, or if next-gen chips like Blackwell are released,
the spot price of existing GPU compute crashes, and that destroys the collateral value for those debt funds.
which means
Companies like CoreWeave, whose entire business model relies on renting those highly expensive, now obsolete chips, and whose debt is collateralized by them, they face insolvency. This will lead to billions in defaults, hurting specific private equity and venture debt portfolios. It will be localized destruction in a highly leveraged segment, confirming that the subprime parallel was accurate in terms of that asset-backed collateral risk.
But the underlying message from the sources is that this crash, or this correction, it paradoxically creates the conditions for the next wave of massive success.
Absolutely. History suggests the market will rebound, but the leadership will change dramatically.
Right.
Post-2000, Amazon and Apple drove the next cycle, not the legacy telecom carriers that built the infrastructure.
Right.
Post-AI bubble, the rebound will be fueled by the collapse in infrastructure costs. Cheap GPUs and cheap compute will enable the companies that successfully monetize AI, the application layer, to thrive. The focus shifts from the sellers of the picks and shovels, like NVIDIA, to the builders of the profitable gold mines, the application platforms.
So the crash actually accelerates the application of the technology by making the foundational resource affordable for everyone.
The source material is very clear on this. The forecast for AI's productivity benefits is real, but it's a marathon realized over the next decade. A market correction simply performs the necessary, painful write-down of assets, making the foundational building blocks cheaper. It democratizes access to intelligence, making that long-term vision far more accessible to startups and enterprises alike. Hashtag outro.
This has been an incredibly detailed and I think a really necessary deep dive. The key takeaway for our listener is this. While the AI boom rhymes with the dot-com era in its exuberance and its parabolic charts, it is structurally different. The primary financial risk is in valuation and the technological obsolescence driven by that unique depreciation cliff, not in the bankruptcy risk of the market leaders.
And we must always hold on to the fact that the AI revolution itself is fundamentally real. Its ability to solve complex, tangible problems in areas like drug discovery, material science, and energy provides a massive, non-speculative floor that the dot-com bubble simply lacked.
But the financial mania surrounding the infrastructure build-out is running dangerously ahead of reality.
It is, and when that fever breaks, it will likely be a harsh but ultimately necessary adjustment.
So let's leave our listener with one final provocative thought, something to mull over as they digest this comparison. If the cost of intelligence, the cost of running sophisticated AI models, becomes pennies on the dollar due to a market correction, what killer app that seems impossibly expensive or financially unviable today suddenly becomes inevitable tomorrow?
That's the ultimate strategic question facing every company. The next generation of trillion-dollar companies will likely be the ones that scale on cheap AI compute. What previously required millions in dedicated capital expenditures might soon require hundreds in monthly licensing fees, fundamentally democratizing the technology and accelerating its real-world impact across every single sector. That's the true delayed opportunity waiting for us in the trough of disillusionment.